I've seen this question a number of times over the last few weeks. It goes along these lines. Given that bonds and stocks have been whacked in the last 6 months, which of those asset classes might we expect to do better in the next 12 months or so? Now, those of you who know me know that I'm not much good at making predictions. My crystal ball was broken when it came out of the box. So if you want a definitive answer to that question, who's going to win between bonds and stocks in the next 12 months, you can stop watching now. I don't have a definitive answer. But the question does deserve a little bit more time. There are some things that we can say about bonds and stocks that might help us with our investment decisions. Let's start with bonds. As we know, bonds have had one of their worst 6 months returns on record. But when you look at the chart here, you can see those rising yields which have led to the negative bond returns. But you can also see that that yield may have reached an apex a few weeks ago and seems to be coming down. Now remember that the bond yields are the market's expectations around inflation and cash rate increases. What this is telling us is that the market's saying, look, we've priced in all future cash rate increases, and if they turn out to be true, then it is going to create significant hardship on households and their ability to pay for mortgages. And of course, that's coupled with higher prices for food and petrol at the same time. That means the RBA are unlikely to push cash rates any higher than what's being priced in. Now, on top of that, given the equity markets are going through a very volatile period, there's a little bit of a flight back to the quality of bonds. Remember that bonds are now yielding around 3 or 4%, where 6 months ago they were yielding 1%. So even though we can't tell you for sure whether yields will go up or down, there's a fair bit of confidence that we're not expecting yields to go much higher. In other words, bonds are probably going to be yielding around 3 or 4% going forward. What about equities? Now, we don't have that nice relationship between yields and bonds in the equity world. Equities, as we know, are a sensitive asset class. They go through periods of joyous optimism and then go through periods of a deep depression. We don't know what is going to happen in the next few weeks, whether the market's bottomed out or whether there's more to go. But we can have a look at previous market downturns, and from the chart you see here, you can see this is 100 years of data. It is US data, but Australian data would be similar. Is after a 10% downturn, the market had fully recovered after 1 year, did even better after 3 years, and better again after 5 years. Even after a 20% market downturn, markets on average have recovered within 1 year, do even better in 3 years and better still in 5 years. And then even in a significant downturn of 30%, then the markets still recover in a reasonably short period of time. So even though we don't know what the equity market is going to do, we can say that equities tend to recover fairly quickly from market downturns. Now, the media is full of stories about a recession. Are we going into a recession or aren't we? We don't know the definitive answer to that. For all we know, the US may well be in a recession, but it may not be. And there's a view out there that if we're going to recession, then stocks are going to go down even further. But when you look at the chart here we're plotting the annual equity returns for both Australia and the US against annual GDP growth. So what you might expect is when GDP growth is negative, in other words, that's the left-hand side of the chart, you might always expect to see that the annual stock return in that period is also negative. It's not the case. In fact, even when GDP growth is negative, it's actually positive stock market returns that we are seeing, at least in this data period from 1980 to 2021. So stock market returns are not related to GDP growth. There's really no correlation between the two. And of course, the reason for that is that when you're looking at GDP growth, you're looking at what's gone on in the past. the equity markets would have already priced in that, and now they're looking forward to the future. So, in conclusion, I can't tell you which will do better out of bonds or stocks in the next 12 months. I do believe that bonds have pretty much worn their pain, and they're probably not going to move around that much more, so they're probably going to sit there and deliver a yield of around 3 or 4%, at least in the short term. Stocks, I have no idea, but I do know that stocks recover quite quickly from market downturns. I also know that the market return is not related to whether we're in a recession or not. And finally, I do know that stocks and bonds typically give positive returns. It's rare when they're both negative, but they do seem both to recover from that quite quickly.